Hey there, and welcome back to Asset Zenith. It's always good to have you here. Whether you're walking the dog, driving to work, or just winding down with your favorite drink, thank you for spending a little time with us today. Now, let's talk about something that might sound a little technical at first, but trust me, it's one of the smartest moves you can make for your financial future. We're diving into the idea of building a balanced investment portfolio. Don't worry, it's not as complicated as it sounds, and by the end of this episode, you'll not only get it, but you'll probably be thinking about how to build one for yourself. So let's get started. Think of your money like a team. You don't want all your players doing the same thing. A football team doesn't have 11 quarterbacks, a kitchen doesn't use just salt, and a great investment portfolio, it doesn't rely on just one kind of asset. You want balance. You want a mix. That's what gives your portfolio strength, flexibility, and resilience, especially when the market gets moody, which it often does. So, what exactly is a balanced portfolio? Well, in simple terms, it's a mix of different kinds of investments: stocks, bonds, cash, maybe some real estate, or even commodities like gold. The idea is that when one part of your portfolio is going down, another part might be going up, or at least staying steady. You're not putting all your eggs in one basket. Instead, you're spreading them out. And that, my friend, is how smart investors sleep well at night. Let's start with the powerhouse, stocks. Stocks are the growth engine of your portfolio. When you invest in a stock, you're buying a piece of a company. If that company grows and becomes more valuable, so does your piece of it. That's how you build wealth over time. Historically, stocks have delivered some of the highest returns over the long run. That's why they're so attractive, especially for younger investors or anyone with a long time horizon. But here's the thing. Stocks can be a bit of a roller coaster. Some days they're up, other days they're down. It can be exciting, but also stressful if you're not prepared. That's where diversification within stocks can help. Instead of putting all your money into one company, you spread it across different sectors: tech, healthcare, finance, and maybe even across countries. You can invest in big companies, small companies, international companies, and those that pay regular dividends. This helps smooth out the ride and lowers your overall risk. Now, while stocks are exciting, they can also be volatile. So we need something to keep us grounded. That's where bonds come in. Bonds are your portfolio's stabilizer. When you buy a bond, you're essentially lending money to a government or a company. In return, they pay you interest, usually on a regular basis, and then pay back the full amount when the bond matures. Bonds don't grow your money as quickly as stocks, but they're much more stable. They tend to hold up better when the stock market is having a rough time. They're like the calm voice in a storm, and every portfolio needs that voice. There are all kinds of bonds out there. Government bonds are usually the safest. Corporate bonds come with a bit more risk but also higher returns. There are even bonds issued by cities and states, known as municipal bonds, which sometimes offer tax advantages. A good mix of bonds can give your portfolio the stability it needs without dragging down your overall returns too much. Then there's cash. And yes, I know, cash doesn't sound like an investment. It doesn't really grow. But hear me out. Cash plays a very important role. Having some cash or cash equivalents like savings accounts, money market funds, or short-term certificates of deposit gives you liquidity. That means you've got money you can access quickly if you need it. Maybe there's an emergency, or maybe you see an investment opportunity you want to jump on. Having cash lets you do that without having to sell your stocks or bonds when the timing might not be ideal. Cash is your safety net. It's the emergency fund in your portfolio, and it helps you avoid making emotional decisions during a crisis. Now, beyond stocks, bonds, and cash, there's a whole world of what we call alternative investments. These include things like real estate, commodities like gold or oil, cryptocurrencies, and even private equity. They don't always move in the same direction as the stock market, which makes them useful when you're trying to build a portfolio that's truly balanced. Real estate, for example, can generate rental income while also appreciating in value over time. Gold has long been seen as a hedge against inflation. Crypto? It's high risk, high reward, but some investors include just a little to tap into its potential. The key here is moderation. Alternatives can add a powerful layer of diversification, but they also come with their own risks. So treat them like spice in a recipe, just enough to enhance the flavor, not overwhelm it. Now that we've talked about the ingredients, let's talk about how you combine them. This is where asset allocation comes into play. That simply means deciding how much of your portfolio goes into each type of asset. How much into stocks, how much into bonds, how much into cash or alternatives. The right mix depends on you, your goals, your timeline, and how much risk you're comfortable taking. If you're young and just starting out, you might lean more heavily into stocks, maybe 70% or even 80%, with a smaller portion in bonds and cash. That's because you have time on your side. You can ride out the ups and downs of the market. But if you're getting closer to retirement, you might want to shift toward a more conservative mix, something like 50% bonds, 40% stocks, and 10% cash. That way, you're focused more on preserving what you've built, not just growing it. There's no perfect formula, but the good news is you can always adjust as your life changes. What matters most is that you have a plan, and you stick to it. Speaking of sticking to your plan, let's talk about something a lot of people forget: rebalancing. Over time, the market will move your portfolio around. Maybe stocks do really well, and suddenly they make up 80% of your portfolio, even if your original plan was 60%. That's a sign it's time to rebalance. That means selling a little of what's grown too much and buying a little of what's fallen behind. It helps you stay aligned with your goals and keeps your risk level where you want it. Rebalancing once or twice a year is usually enough. It's like tuning up your car, not exciting, but necessary if you want to keep running smoothly. And finally, let's talk about the bigger picture: why a balanced portfolio really matters. Markets will rise and fall, that's a given. There will be good years and bad ones. What keeps your money safe, growing, and working for you year after year is having a solid plan and sticking with it. A balanced portfolio gives you the confidence to stay the course. When other investors are panicking and selling, you'll know you've already built a safety net. Your stocks might drop, but your bonds and cash can soften the blow. Your alternatives may even hold steady or rise. And over the long term, this kind of steady, consistent approach tends to outperform the more emotional, reactive strategies that many people fall into. So, if you're just getting started, don't stress about building the perfect portfolio right away. Start with a basic mix. Use index funds or ETFs to get broad exposure. Be patient. Be consistent. And check in every now and then to make sure everything still fits your goals. Because building wealth isn't about getting rich fast, it's about growing wisely. It's about staying balanced. And that's exactly what you're doing right now by learning and planning. Thanks for joining me today here on Asset Zenith. If this helped clarify some things for you, I hope you'll stick around. Like the video, subscribe to the channel, and maybe even share it with someone who's ready to take control of their financial future too. Until next time, keep learning, keep investing, and most importantly, stay balanced. Take care.